looks like the drama surrounding the potential takeout of Healthscope has gotten a lot more interesting of late. Obviously, we had the Canadian private equity firm Brookfield lob a bid the other day coming in at 250. That does trump the BGH's led consortium's offer of 236 by a whopping 6% or $250 million. And they do invest alongside of their own fellow Canadian, I should say, 10% holder of Northfield, which is a REIT. So it is kind of an interesting mix. I wouldn't say myself. But aside from typical conditions that kind of had with the Brookfield scheme of arrangement, that's what the offer was through. It was all a cash deal. Then you have your typical due diligence and, of course, your financing. You have to have the approval of both the internal committees as well as the board and get a thumb up from the regulators. This offer is quite unique in that Brookfield really needs to drive a wedge between Australian Super's 14% holding in the company, and that is significant enough to defeat any would-be scheme of arrangement with BGH. So they are calling on really the board really to do its dirty work for it, really calling for what's called a level playing field proviso in that, where the board would actually deny any would-be suitors access to Healthscope's books if they were under any exclusivity agreement not to vote their shares for a superior offer. So in effect, if the board did grant such a proviso, it would effectively block Australian Super from doing any due diligence, and therefore they couldn't really look to see this is really worth their time. And interestingly enough, in the same breath, Brookfield actually required their own exclusivity deal through the board, saying that the board should not grant any other due diligence to any potential acquirer on superior terms to its own. Yeah, Canadians gotta love them. Anyway, and they also threw in there a little enticer for Australian Super to really hitch its wagons to Brookfield in lieu of BGH, saying that the provision allows for existing shareholders to, and I'll quote it, have a significant minority position in what would be obviously a privatized Healthscope. Now, obviously, there's a lot of questions what's going on. I've heard that the board's going to meet this Friday to discuss this, amongst other things as well. But for investors, I guess I would say the key things you really need to focus on is, one, is the bid from Brookfield up, the 250 bid, is that going to work? Is it not going to work? And two, is this a bidding war, and is this thing going to move further north? Now, obviously, it's difficult at this stage with all these moving pieces to know how this all is going to flush out. But for the Brookfield bid to hold weight, Australian Super would have to flip, or BGH consortiums would have to dissolve. And I'll just remind you that the consortium is locked up for 3-month exclusivity clauses post any word back from Healthscope rejecting their current bid of 236. And members can act independently, but only after 6 months. So there is a potential that consortium could dissolve, but we believe that it's actually quite unlikely. It appears that Australian Super is very much wedded to BGH, and they even said so. They said they will reject, quote, I'm quoting, they will reject, vote against, or not accept any proposal for Healthscope other than its own. So just logically, if you think about this, why would Australian Super want to pay more via a Brookfield deal and end up with less, a minority shareholding? So it makes no sense to us at all. So why the Brookfield deal, I do believe, adds more competitive tension to this mix and actually maybe gives the board a little more fodder to ask for a higher bid on the BGH 236 deal. I don't believe really Brookfield's punt is going to get up, given what I just talked about. And let's not forget, scheme of arrangements aren't the easiest thing to do. They normally run 4 to 6 months. That's what's typical for those type of deals. Healthscope is still contending with a myriad of different challenges operationally they need to get through as well. And upside from current levels here. Now let's look at the 250 punt from Brookfield. That equates on an EV to EBITDA on a fiscal 18 to 19 consensus number of 14 to 15 times. And I said this before, I'll say it again right now. That's significantly above what TPG paid for Healthscope back in 2010 when they privatized them. It's actually up 40% above that level, and it's 20% above what Ramsay is currently trading on. And Healthscope is not a Ramsay. Let's get that straight. So bottom line here, I'd be inclined to take some profits here. I'd be inclined to take those funds and cycle them into names that have more value and more visibility. But for I know those people that are thinking, maybe there's a little more into it. You know what? Maybe keep some powder dry. Don't take it all off the table. But I think right now that's the best move you can make.